Well, thank you for joining me today on this week's weekly update. This week's question is actually about interest rates. With the Fed expected to raise rates, how are you going to change the positioning of the portfolio for this eventuality? Kevin Warsh, the new Fed chairman, is actually speaking in front of Congress today as I'm talking about some of this. And there's been a lot of questions as to what they're going to do. Because part of the reason Kevin Warsh was put in place is people thought, oh, he's going to automatically lower rates. Ultimately, though, the Fed is an independent organization. It's not beholden to the president. And the Fed has a dual mandate. It's full employment and low but stable prices, or low inflation and stable prices. With that in mind, what's going on in the market today? Well, if they're trying to engineer a soft landing, not crush the economy, they're looking at employment, and employment's near historic lows. So we probably have near full employment. There's a little bit of weakness in the jobs we've talked about in the past, and not enough new jobs added. So there could be some rationale to lower rates as a result of that. The flip side is inflation's been higher than expected for a while, and there's a good rationale to maybe raise rates to fight that off. So there's a little bit of competing forces between that dual mandate. It's one of the reasons the Fed's job is so difficult to manage. If you think about the higher rates to fight off inflation, you also have to be pretty sure that inflation's on the way. And we just had a much lower inflation print month over month. Core inflation looks to be about 2.6, and shelter, which had been one of the biggest components of inflation here for the past several years, actually just printed its lowest year-over-year increase since 2021. So, with gas prices coming down, like we said a few weeks ago, the headline inflation rate came down, but the core inflation rate is the one you want to look at the most. With numbers like that, what is the Fed going to do? And the answer is it's very difficult to tell. And this is a chart of Fed interest rates. So let's take a slightly closer look at it here. If you look back in the 1990s, we talked about this before, there's this sort of tabletop effect. The Fed rose rates very, very quickly in 1993, crushed the bond market. They went up, they stayed up, the market reaccelerated, and then they raised rates again, and then there was something wrong in the economy, there was a recession, and they dropped it very quickly in 2000. Right? The Fed today, they went up rapidly in 2022, crushed the bond market, went up, stayed up, came down a little bit, and then now we have these green lines. That's the market expectation, what the market is betting is going to happen over time. There's the blue section, which is the Fed's estimation of what they might see over time. There's the purple, which is where they want to get to over time. And one we don't talk about as often is that gray area, is the range. That is, since the start of the year, the range has been up and down and kind of all over the place. And this is why it's so hard to call which way the Fed's going to go exactly. But one of the things the Fed has control over is short rates. What they don't have control over is long rates. Do they have an effect? Yes. But what is the price of a 10-year Treasury today? That's much more determined by the market, future inflation expectations, economic expectations, and the ability for governments to pay it back. That's what drives the 10-year Treasury. The overnight rate, though, is driven by the Fed. They pretty much have total control over that. So when you say interest rates are going to rise, the real question is which interest rates and how fast and where. The 30-year Treasury, if you bought a 30-year Treasury in 2022 on January 1st and held it through the year, it's very likely that by the end of the year you were down 39% on 30-year U.S. Treasuries. That's what happens when you go long, what we call duration. You take long bets based on interest rates going down over time. Or conversely, if they go up over time, you lose. If they go down over time, you win. That's a big risk to take. And it's been our philosophy for a long time that taking long interest rate risk. I don't think people buy bonds, fixed income, what I think most people consider their ballast to their portfolio and their safer side of their investment allocation. It's very difficult to tell somebody you're losing 39% buying U.S. Treasuries, what are supposed to be safe. Right? I think that's a mixed message. So we tend to take a much shorter duration and have for some time here. But what that means, what duration really means, is if you have a duration of 10, it's usually expressed in years, 10 years, that number means that's how much the underlying bond is set to move if interest rates are to move 1%. So if interest rates are to rise 1%, for an equivalent bond, you'd expect this bond actually to drop 10% in total value. The opposite is also true. If interest rates drop 1%, you expect the underlying value of the bond to rise 10%. And then there's some other convexities and complexities to that conversation. But generally speaking, that duration number is how you determine how much interest rate risk you're really taking. Are you trying to make a big call on interest rates? And our attitude for a long time has been, let's take much shorter duration risk. If you're collecting 5% on 5.5% on bonds, and you have a 1 year duration, and interest rates rise 1%, you lose 1% in the underlying bond, but you still get to clip your coupon and collect 5.5%. Most people can live with that. That's kind of the design of how bonds are set up. So what we tend to do is we tend to try to look at taking more credit risk. And why do we look at more credit risk? Well, right now, historically, spreads between investment grade bonds and treasuries are historically tight, meaning you're not getting paid a whole lot more to go out and lend money to a company versus what we traditionally call the risk-free rate, or U.S. treasuries. And if you're not getting paid a whole lot more, how do you go out and devise that? And that's one of the reasons on bonds we often look at using active managers to try to go out and capture some of those credit opportunities. And so they lend to companies that may be a little bit further down or don't want to pay to get rated by the agencies, or although are very good credits, just for whatever reason need to pay higher interest rates because of maybe the size of their business. Those are things that we want to look at as an opportunity for clients. So we tend to take a little bit more credit risk on the short end of the curve and try not to make big interest rate calls. So when people say, how are we positioning the portfolio for interest rates rising and falling? The answer is we're trying not to make huge calls on which way the Fed is going to go, or more importantly, which way the market is going to drive rates on something like the 10-year Treasury. We're trying to collect really good coupons and keep that section of people's portfolio relatively safe, which is how I think most people view their fixed income or bond side of their portfolio. So with that, thanks for joining me today. If you have future questions, you know where to send them. Why Nations Fail is this 2 months book recommendation. I hope everyone has a wonderful weekend, and we'll see you next week.